They are still awaiting Bob Iger. So that means that this is not a pre-recorded message that he is delivering exclusively to CNBC. This will actually be a live thing. It just now came back up, so we now have the numbers. Jonas and Mike, if you could go onto the page and pull those for me so I can focus on this.
All right, me and Jonas will focus on the report. Let's go, Jonas.
Meanwhile, while they do that, is to say I'm in complete agreement with your analysis. Him doing this before the earnings call, that can only mean that he wants some positive headlines out there already as he delivers one bomb after the other.
Well, we already see on the screen here the Chiron with CNBC revenues miss $21.24 billion versus the estimated consensus on Wall Street was $21.33. Now, that's not a humongous miss, but again, there's a lot of details in there that we have yet to see. So let's see what's happening here. And again, this is probably why, again, I think Bob Iger is coming on to CNBC to perhaps mitigate some of this. I have a feeling there's going to be some kind of big announcement here.
You reiterated that you're on track to hit profitability as planned, but a big beat on subscribers. You also recently just raised prices. And I'm wondering if you expect that subscriber growth to be able to continue.
Well, we do expect subscriber growth to continue, but we're mostly focused now on delivering profitability by the end of fiscal 24. We had a great quarter, as you just noted, adding 7 million core Disney Plus subs. That was really the result of great content, particularly 3 strong movies, Guardians of the Galaxy 3, Elemental, and Little Mermaid. Disney Plus is proving to be extremely popular and in demand, and we feel very bullish about its future.
So what does the future of your streaming bundle look like, especially given the fact that you're about to, or you're in the process of buying out the remainder of Hulu that Comcast, CNBC's parent company, currently owns? And how much do you expect to have to pay over that base level that you already negotiated for that remainder of Hulu?
Well, first of all, as you know, there's a floor price, which is obviously public, stated. We'll be writing them a check for that actually pretty soon. There will be an evaluation process that is dictated by the agreement that we reached with them a few years ago. I'm not going to say much more about that process, except, we expect it will be fair and ultimately objective, and we're not concerned about the price that we will end up paying. It's a great step for the company from a strategic perspective in that it gives us an opportunity to further connect the dots between Disney Plus and Hulu, and ultimately offer even a 3-play or a triple bundle with ESPN. There's 3 great sets of streaming assets. And in December, we will launch in beta form a combined Disney Plus and Hulu app.
How important is ad-supported going to be, and what kind of growth are you seeing in streaming advertising versus linear advertising? Because we've seen, and even in this quarter, linear advertising is really struggling.
Well, we can talk about both. First of all, we believe that the advertiser-supported streaming services, not just in the U.S., but in other markets, notably in EMEA, will be important growth initiatives for the company. In fact, in Disney Plus, we just implemented some really robust advertiser targeting tools that are already working and will help us obviously grow advertising. By the way, speaking of advertising, addressable advertising is very strong. And since you raised it, so is sports, by the way. I would say in linear, it's actually a little bit better than it had been. Overall, we've seen some improvement in general in advertising. It doesn't mean we don't have more improvement ahead. We actually believe we do. For instance, technology sector has been a bit soft, but advertising looms large for us. And the combination of Hulu and Disney Plus advertiser supported is a great opportunity for us to grow the advertiser supported side of our streaming business. We obviously are planning to take ESPN out on a direct-to-consumer basis. We feel great about that. We believe we have an opportunity to strengthen that hand even more by bringing in 1 or 2 strategic partners that can add either marketing support, technology support, or possibly content support.
How essential is it for ESPN to have those rights, and how problematic is it that you have these big tech companies pushing up the prices?
Well, I'm not going to comment about the negotiation at all, except to say I've said before, the NBA is very important to ESPN, has been for a long time.
$75 billion next year, folks.
ESPN's important to the NBA, too. We bring to not just the NBA, but to other sports organizations a level of support, engagement with audiences, not just on linear television, but in podcasts, on radio, and online and in apps, and I could go on and on. That's quite valuable to these sports organizations, and I don't think that should be discounted.
Disney was in a battle with Charter about what the future of traditional distribution should look like, and Charter really pushed to bundle streaming rights with digital. How did that battle and the resolution of that change the way you're thinking about potentially selling these assets?
We have uncovered a number of really interesting opportunities to reduce costs and improve the business. And in fact, you have to look at the business in terms of its strategic value to the company too. Not only its financial value, and by the way, it is profitable still for the company, but it provides a lot of strategic support for ESPN. There are a number of sports shows on ABC, for instance, for ESPN. We also bundle when we with the distributors, ESPN and those linear assets. And it's also those linear assets are very valuable for streaming, Hulu and Disney Plus. So we are looking in an open-minded way, but that shouldn't in any way suggest that anything is imminent. It should suggest that as part of our ongoing process, we're very, very realistic about the marketplace and the future of those assets, but we also are very mindful of their value to the company today and possibly into the future. And the Charter deal, to answer your question, didn't really change our opinion about it. Like, that was a great deal for us. I think it was also a very good deal for Charter. It did enable us to reduce the number of channels that we were distributing through Charter, while also giving us some great distribution for our streaming assets, notably Disney Plus. So kind of, I'll call it a win-win for us.
But does that mean that, given that you're selling effectively a smaller bundle of channels to Charter, that ultimately you'll have to shut down some of those channels? And do you think other distribution deals will follow in the same path as Charter's?
Well, first of all, our core channels were part of the distribution deal. So when we talk about possibly shutting channels down, we have a lot of channels. I've argued for a long time, possibly too many. I think that's true actually for the industry. Over time, with the growth of cable, a number of channels were created. I'm not sure that serves the distributor or the consumer that well, but that's maybe for another time. But I like the fact that we're focused on fewer channels. And I obviously love the fact that we were able to bundle a very, very core future asset for the company, Disney Plus, into that deal.
You said that you're looking at all of your assets. Do you have plans to sell your India assets?
Yeah, this is going to take us right up into it.
Update there?
This is
crazy. I don't have an update.
I've never
I'd say
seen
the same thing about them that I said about our linear networks. We're looking in an open-minded way.
Linear networks are a little bit down, by the way, about 10%.
He's basically doing the earnings call on CNBC.
Where that will end up.
I want to ask you about Nelson Peltz.
But why?
The stock has
Here we go.
% since Nelson Peltz declared the proxy fight over. He indicated, and he has teamed up with Ike Perlmutter, who formerly ran Marvel, that he is perhaps preparing for more activist action against Disney. Have you heard from him?
I had a call from him, but I must say I don't have specifics about what Nelson is really after or what he will ask for. I will say that as
so
is the
they're
case,
adversarial.
The management and the board is always willing to listen to what shareholders have to say.
No, you're not.
We're in lockstep with the board in terms of our
That's the problem.
and our challenges.
You're
and
in lockstep
our
with the board.
strategic
You are the
direction.
board.
We all feel very optimistic about the future of the company.
The board is in
I don't have
lockstep
anything
with
more to
him.
add
That's the
really about
problem.
that. Although I will say, in terms of your comment about our stock price,
Yes.
we don't manage the stock price, for short-term gains or on a short-term basis. We have a long-term view.
Now, you just announced a new CFO, Hugh Johnston, who has dealt with Ike Perlmutter and his activist actions in the past when he was at Pepsi. Do you think he'll help you in any potential battle?
That wasn't an accident.
First of all, we feel very fortunate to have been able to hire Hugh. I'm looking forward to working with him. He starts in a few weeks.
I think she might have meant
he'll be helpful to us in a number of different ways. I'm looking forward to being a partner of his.
Certainly a lot of different financial changes potentially. You are doubling down on the parks. That's one big financial change. Announced that you're investing $60 billion over the next 10 years. Are you concerned about?
They're going to ride this all the way to the earnings call. This is crazy.
I know. I can't believe this.
Well, if you look at our track record, particularly the last 5 years of the parks, but you could look back another 10 years, it's been stellar in terms of return on invested capital. The investments that we've made in that business just by the way, and domestically, but also globally, have really paid off. And they've each paid for themselves in many ways. And since we make decisions about capital allocation that are based on what we feel is the best way to deploy our money to deliver shareholder value, we felt in looking at the results of the parks that since the returns have been so strong, why not invest more? It was as simple as that.
It's because they're milking
the
DVC and cruise
is
lines.
very bright for those parks. You can look at the results today and see that not only are domestic parks doing well, or we've got some difficult comparable or comparisons in terms of the Florida parks, but the international parks are doing extremely well, as is our cruise business. So when we looked ahead at how we'll allocate capital, and you mentioned the guidance that we gave about growing free cash flow in fiscal 24, we decided that a great place to place our bets or our capital is in the business that's delivered the best results.
Yeah,
we're not
but not in the U.S.
The U.S. represents 80% of their parks' income. So dating
back to 2008, 2009, for instance, or 2011 with what happened with the terrorist attacks. And again, those are I don't want to
really going
say
there
blips because they're significant, but they come and go, and we've seen that. And we don't invest for any one specific time. We invest for the long term.
Well, before we're out of time, I want to make sure to ask you about the strike.
For that, but
the
they're not
Screen Actors
addressing
Guild is still on strike. There are
the
picketers
underlying
outside
issue
the lot where we are right now. Bob Iger, CEO of the Walt Disney Company, thanks so much for joining us here today at your headquarters. I know you have an earnings call coming right up.
I do, Julia. Thank you very much.
I'll send it back
right
to you
now.
guys.
Pre-recorded for a 5-minute perfect
interview and to
buffer
Bob
between.
Iger as well, with shares of
Could
Disney
we just
higher
keep
right
her
now.
on
Let's bring
screen
in
for the
CNBC
earnings
senior
call?
markets commentator Mike Santoli.
Yeah. So, I mean, okay, look, let me address some of these things. They get to the movie question last, and he's like, well, that's only a small part of, I know, I get that. We've talked about that for 2 years. The problem is the $60 billion CapEx that they want to drive into parks over the next 10 years, right? And the big change is not so much the CapEx itself, but it's where they plan to spend it. And this is in cruise ships and overseas parks.
China.
This is not going to be largely spent here in the U.S. This is Disney putting it overseas. If your creativity is dead, if you're not building new IPs, if you're not, if Marvel is just dying, Star Wars is dead. I mean, you've paid collectively between those two things nearly $10 billion. And they're just falling apart because you're not great storytellers anymore. You don't have the creative minds at the Walt Disney Company to actually drive the growth of those things and the continued success. Then what are you going to the parks for? People go to the parks to chase the IPs, right? That's the driver. Look at Universal. Look at what they're doing with Epic Universe. Look at Harry Potter World. Look at all this stuff. I mean, there hadn't been a Harry Potter movie in 15 years, whatever the hell it's been now. And that Harry Potter World is like the golden standard of immersive experiences.
It's packed full of people wanting to spend $60 on plastic wands.
Yep. Andre.
Did anyone notice that Bob looks like he's aged 10 years in the last 1 year?
No, I was going to say that. I think I even blurted that out during that interview, Mike. That's a great point. Bob Iger, I know there was rumors that he had, and look, God bless him. If there's something going on, I will never never wish ill on a person like this, but he looked very much different than what he did relaxed in that chair outside on the lawn in July, the last time he did an interview with CNBC right after he got renewed for 2 years.
We didn't hear the big announcement we were looking for. From that, I didn't hear any major big announcement.
Nope.
This was damage control.
This is a guy in panic mode. This interview took place in Burbank, at the Walt Disney Company, obviously. And I'm not. After the earnings call, I'm going to speculate a little bit on what I think's really going on. But that'll be like stay tuned. But because I've had some experience in corporate governance, a little bit, not a lot. I'm sure Andre will probably have the same thoughts that I've got. But there was no big announcement, which is what we all expected there to be.
Right.
Instead, this tells us a lot more about the way you look at it. It wasn't prepared, and it also wasn't packaged. All of those questions weren't packaged. She threw out some questions that I don't think he was ready for.
Yeah.
The big the non-announcement that is an announcement, I would suggest has to do with Nelson Peltz. When Bob Iger says he doesn't know what he wants, when he does not deny the interviewer when she presents the new CFO as being counter to Nelson Peltz and the Trian Group, when Bob Iger does not push that back and say, no, we're all getting along.
Yep.
When he does that, folks, I think the tell here is this is going to be an adversarial proxy war coming up for the Walt Disney Company. I think that's the big news out of what we just watched. Framing an earnings call.
I think you're on point. I thought he got the CFO because they'd be friendly to Peltz. I think he got someone that's battle hardened with Peltz.
Yeah, I'm there now. I had some question earlier, but I don't know.
Yeah,
Andre.
Yeah, and as for me, I agree. I think that what we saw right here was desperation. I think the whole purpose there is that he wanted some talking points out. I think specifically like this mystery partner that he wasn't ready to announce yet, some talks going on. I think that was in lieu of an actual announcement. You know how like you have like in Marvel movies, like, okay, fine, this thing here is a little bit shit, but get excited for the next thing. I think that's what this was. That was the corporate equivalent of a Marvel post-credit sequence. Like, oh, we're working on something. Get excited. I think that was the whole point of this whole thing here, to create some kind of buzz and excitement. I don't think it's going to work though, because the rest of the stuff there, he seemed nervous, he seemed uncomfortable, and he just went on and on and on and on and on and on, and basically he did the whole earnings call right there. What's left?
Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.